In our last video, we talked about the mandated coverage of an ERISA bond when you have a retirement plan. Today we're going to talk about fiduciary liability, what it is and why it's needed. First, it's important to understand that the ERISA law imposes liabilities on retirement plan trustees and administrators, broadly known as fiduciary duties. The trustees of a plan have the responsibility to run the plan solely in the interest of the plan's participants and their beneficiaries for the exclusive purpose of providing benefits and paying plan expenses. They must act prudently and must diversify the plan's investments in order to minimize the risk of a large loss. In addition, they must follow the terms of the plan documents and avoid conflicts of interest. If a trustee or an administrator of a plan violates their fiduciary duties, they may be sued and held personally liable to restore losses to the plan. Extra emphasis is added to the words personally liable. This is a minefield where your personal net worth as a trustee is on the line. Courts may take whatever action is appropriate against fiduciaries who breach their duties under ERISA, including their removal. In short, plan fiduciaries must do the right thing for the benefit of the employees participating in the plan and for their beneficiaries. If a trustee acts imprudently or violates the rules, they can be held personally liable, meaning their personal assets are at risk. As you can see, this presents a credible and dangerous risk to those involved in managing ERISA-based plans. Typically, the trustees and the administrators of a plan are the business owners or business leaders, only further adding potential headaches they can suffer. How do you protect trustees and others from ERISA duties from this personal liability? Through a fiduciary liability policy. Fiduciary coverage is typically added to a management liability policy, which will include your D&O and employment practice liability coverages. If you purchase D&O and/or EPL coverage, be sure to add in the fiduciary, which usually is around 10% of the policy premiums. Not bad for what it protects. Here's a quick recap. ERISA imposes duties on business owners who are usually the plan trustees of a retirement plan. Violation of those duties place their personal assets at risk, which is not covered by any other liability policy, which is why you need fiduciary. In my next video, we're going to talk about employee benefit liability, or EBL as it's sometimes called, and this is where many insurance agents get confused between EBL and fiduciary coverage. Have a question or concern when it comes to your potential liability in relation to a benefit plan? Why not contact me so we can start a conversation? No hard selling, just conversation to see if we might be a good fit for you. Thanks.